Amazon is materially changing the housing market here in Nashville. I'm going to explain exactly what they're doing and give you some data points. I'm also going to include a Nashville housing update. And then I'm going to give you a tip on how to look for a crash. And believe it or not, there are crashes happening in Nashville right now. Of course, you wouldn't notice it because nobody wants to buy there, but I'm going to show you how to identify them, both how you can do it practically, and then I'm also going to show you what I personally do. And then we're going to talk about some headwinds going forward because there are some headwinds. So I posted this the other day, first week of May. Amazon announced that they were going to be leasing 3 floors in the Asurian building. This is major news, y'all. We have had empty Class A, super nice office for years. I'm talking about years. We have to go back to 2023, early 2023, some of this late 2022, and now we're starting to see it fill up. This is a complete tone change, but Amazon is renting 3 floors from the Asurian. Then they announced they're going to rent another floor from CAA. They're going to be leasing an entire floor in that building as well while they finish out their Tower 2, which should be completed in 2026. Let's talk to multiple people now that have accepted positions with Amazon and are moving to Nashville because of it. This is a big tailwind for Nashville, and it is major because we're talking about 3,000 additional downtown jobs. These are high-paying jobs. These are corporate jobs. And what's interesting about this is Nashville is a complete outlier for office occupancy. This is the Kansas City Fed. Now, this is just for downtown, so it's not an entire MSA here, but it says accounting for changes in downtown office occupancy since the pandemic. How can you have 16% more occupancy today than you did, which, by the way, this is 6 months old, so this doesn't even include the Amazon piece. But how could you have that much more occupancy and yet office crash? And this is really interesting, y'all, because I think this is exactly what is happening in our housing market too. Let me read you a quote, and I think this explains everything. Over the past 3 years, annual net absorption, which just means how much incremental more office space has been leased. That's what they're saying here. Annual net absorption in buildings constructed since 2020 has ranged between 1.2 million and 1.4 million square feet annually. This is a big contrast to buildings completed before 2015, which had mostly negative net absorption. Everybody is moving into the nice new stuff. And guess what? That's exactly what's happening in the housing market too. Now, this is why we can see massive crashes in some office downtown, and at the same time, see record high prices for certain commercial real estate, including offices, at the exact same time. This is exactly what we're seeing in our housing market. And believe it or not, Nashville prices for the end of the month of May, reported by the Greater Nashville Realtors, might be at an all-time high for single family for May in 2025. It's shocking. Inventory's higher than pre-pandemic. Our demand is down almost 30% pre-pandemic. How in the world could we be at an all-time high in median sales price? I think the office paradox is the same thing as the house paradox. It's not just median sales price, median contract price. It's touching the all-time high. 525, that's where we were in November. That's where we were in early May of last year. And sure enough, we're back at that all-time high under contract price. This makes me think not only May is going to be potentially a record high, but we're not going to see price relief in June just yet, which is kind of shocking to me. Now, I'm going to show you where I think the softness is and where the crashes are. So I'm not trying to just be Mr. Bull here. Believe me, there are headwinds. I'll explain where the headwinds are, where the headwinds might be in the future. But right now, even in price per foot, median contract price per foot, all-time high at $253. Median price per foot, all-time high at $249.9, basically $250. Now, I do expect, I still stand by this chart. I posted this the other day on Twitter, and I stand by it. I do think by July, we're going to see a lot of the people that didn't sell their houses motivated to sell, and prices will start dropping. They'll drop fairly rapidly in a short amount of time. But I got to say, with as strong as May has been, I'm no longer expecting June to be negative. I think we'll see June potentially be positive for the single family median price. That means that we could probably adjust this up a little bit. Are we going to hit lows? It's just not clear to me yet if we are. Now, we can also see this in rents. There's been a big tug of war in rents. I thought rents were peaking in April. That was kind of a bearish scenario for me. I was kind of excited about it. And rents not only popped after I thought, oh, have they peaked? They popped. There now is a tug of war on which direction they go. And there's a lot more demand. I am shocked, but there is more demand than I would have expected, even for people renting apartments and houses. It's baffling to me, especially since the immigration stuff that's happened, because there's been a lot of ICE raids in Nashville. If you haven't been following the news, there's been a lot of ICE raids. There's been a lot of impact, but we're just not seeing it in the demand. I want to explain to you how I find where the crashes are here in Nashville. So if you use RealTracs, which I kind of recommend using, but you can use whatever you want. RealTracs is actually the MLS. If you go to listing status and just click under contract and active, so you can see both what's gone under contract and what's active, you can start finding some of these areas. Let me show you what I'm talking about here. Look right here. Okay, look right here. There are 28 listings and not one of them is under contract. Not one is under contract. That's a crash, y'all. That looks like Florida inventory there. These are the high-rise condos. But even 1212, look at this. When you have a new build condo right next to your 10-year-old condo, look at this, $379, $568 a foot. And they are literally price warring 1212, $604 a foot. Would you buy a 10-year-old condo versus a brand new one? I don't know. I mean, I haven't been in either, but I'm telling you, it's a price war. It's a crash. They're crashing. So condos are crashing. Let me show you another one. The Enclave. Look at that, 12, none under contract. Do you think they're getting showings? I have a tool that I built. I give it to all my buyers. You can, if you're a professional, if you're a builder or an investor, you can also get this tool. But one of the ways I changed it was I actually took the active to under contract, okay, that ratio, and compared the ratio to the same neighborhood the year before. And so what you see is all these dark blue areas are areas that are much, much less competitive than they were last year. And vice versa, much more competitive than they were last year. One surprise on here that's more competitive, Witherspoon. This is a $3.3 million neighborhood, 5 active listings, 5 under contract. It feels like there's a month supply in this neighborhood. Feels like there's a month supply in this neighborhood. And yet we can see prices have dropped over the past year. So that's pretty interesting. And now what we see is even though prices have dropped, and you can see they've been dropping, I mean, stuff has been going for $400 a foot. Some of the stuff has been going for $400 a foot. Now we're seeing everything under contract above $500 a foot. Isn't that interesting? So you can see that they're clearly moving up in price, more demand and tighter, even as a neighborhood, just 2 neighborhoods down, Governor's Club, it is much, much slower. Governor's Club's a little bit older, and you guys tell me why it's not as attractive. Troubadour is way, way, way slower. Last year, there were 7 active listings with 4 under contract. This year, 11, none under contract. Look at that. It feels like over a year's supply on the Troubadour. I mean, these are like $5, $10 million houses. Yeah, median's $5 million. Nonetheless, that's crazy, isn't it? But let's come back up here. So what I actually have a buyer right here on Young's Lane. Okay, he's interested in a house on Young's Lane. All right. This is where this tool becomes practical. Last year, it felt like there was a 7-month supply. There were 14 active listings. 2 had gone under contract. But here's the thing. We know that only 8 have closed over here in the last year. Only 8 have closed. And there are 36 active listings. Well, that's like a 4.5-year supply. Something is about to break here. Here we go. 4.5-year supply. This is where all the listings are. And not one is under contract. If you want to look for crashes, you got to look for where the active to contract has just completely blown out, where there's just nothing under contract, but there's a ton of active listings. Headwinds, I'm just going to hit these real quick because I do want you to know that even though we have high prices, even though the contract prices are high, that there are some headwinds out there that you need to be prepared for and keep an eye on. The student loan repayment, this could be problematic. Obviously, Nashville is a great college city. We have Vanderbilt, we have Lipscomb, we have Belmont, we have TSU, we have MTSU, which is just in Murfreesboro. I mean, there's a lot of university, a lot of students that stay around, a lot of students with college debt that move to Nashville. I think the student loan repayment could be a headwind. Very hard to measure, but it's something to keep an eye on. Inventory growth is problematic. It is continuing to grow rapidly, although I would say May, in my opinion, was a little bit of a disappointment, especially when you look at the demand increasing. It didn't really grow as much as I would have liked to see. Interest rates continue to be a headwind. If you've listened to this channel, you know that I still think that interest rates could go higher. It's obviously a risk. Interest rates could go higher just because the debt binge. And believe me, you think that just means that housing could crash. I disagree. All those interest rates, interest expense is going straight to investors who are then buying up real estate. So this is going to be one of those things that continues to create the wealth gap, is what it is. I know that higher interest rates make it harder for individuals to buy housing. And that leads me to my last point, inflation and government spending. It is out of control. Inflation, you look at trueflation, is now above 2%. It's continuing to go up, even though I know some of y'all are seeing prices drop. Thank you for watching. If this video is helpful, click like, and I look forward to seeing you next Saturday. Thanks a lot.